Welcome to the video. This video is going to be on fixed assets. Before we get started, I just want to thank our sponsor, which is no one, because I have 2 subscribers. In today's video, we're going to be covering a definition, the different types of fixed assets, what the difference is between fixed assets and current assets, and a brief look at a fixed asset register. So firstly, let's go over the definition. A fixed asset is an asset purchased for long-term use and are not likely to be converted into cash quickly, such as land, buildings and equipment. Now there are a few criteria that you'd want to look at when determining whether we want to classify something as a fixed asset. What does it cost? What is its purpose? And how long do we intend to hold it for? So starting with what does it cost? It's important at this point that we talk about something called capitalisation. Capitalisation is essentially where we decide to classify something as a fixed asset. That is it. That brings us nicely onto something called the capitalisation threshold. This is where we determine a financial limit that if we spend above it, we will automatically capitalise something, i.e. assign it as a fixed asset rather than a current asset. An example of this would be if you were to set a capitalisation threshold at £250. If we were to buy a printer for £300, we would capitalise it as a fixed asset. However, if we bought a printer at £200, we would expense it directly to the profit and loss. Next is what is its purpose? When I say purpose, I mean its purpose in relation to the business. If you're a delivery man, you would obviously capitalise or recognise as a fixed asset the purchase of a car, because it's obviously going to be used over the long term and you can't easily convert it into cash unless you have a line of buyers waiting outside. However, if you're a car dealership, you wouldn't capitalise a car because that's what you sell, and so you would make it a current asset under your inventory because it's going to be sold relatively quickly because people are going to be coming to you to buy a car. And finally, how long are we holding it for? Generally, if we're holding an asset for more than 12 months, it is non-current and therefore a fixed asset. However, if we're looking to keep it for less than 12 months, like inventory, trade receivables, it would be current and therefore not capitalised as a fixed asset. So what is the difference between a fixed asset and a current asset? Well, as we've already discussed what a fixed asset is, a current asset is essentially everything else that could be classified as an asset but doesn't fall within the realms of a fixed asset. So something that can easily be converted into cash or is cash, such as trade receivables, because it's money that people owe you, so you can ask them to pay you and they pay you, or inventory because you're constantly going to be buying stuff and selling stuff, so that's going to constantly be moving, so that's going to be easy to convert into cash, and you're not holding it for a long time. There are a few other items that you could classify as current assets, such as prepayments or accrued income, but that's current because we're not easily converting it into cash, but it's less than a year. Anything more than a year we would have as a fixed asset for prepayments or for accrued income, but that's not usually the case. So now let's move on to the different types of fixed assets. Now there are quite a few common ones that we have, such as land and buildings, property, plant and equipment, fixtures and fittings, and office or IT equipment. However, they're not limited to these and you can easily just create your own. It just depends on your preference, as you don't actually have to report the different breakdowns of your fixed assets when you do your company accounts. The reason we split these out is because each asset is going to have a different expected life. Now I can tell you for sure that a building that you capitalise as a fixed asset is going to have a longer life than a car, for example, and the longer the life of the asset is, the longer that you'll be depreciating it for. I'm going to do a video on depreciation, the different types of depreciation, but for this video just know that depreciation is essentially a tool we use to reduce the value of an asset over time to reflect its fair value, to reflect its change in value as it gets older. Now, as promised, I'm going to show you an example of a fixed asset register. This is what we use to track all of our fixed assets for our clients and depreciation we charge on it and the final values at each period end. So here is an example of a fixed asset register. So as you can see on these tabs, we've got our summary down here, and then we've got our individual fixtures and fittings tab to go with this, and our IT equipment to go with this. Just to give you a brief overview, we have the costs here, any additions here, and then the cost carry forward. So the carry forward is what will go into the next period. And then you've got accumulated depreciation, which is just the total depreciation that has been charged. And then we have the charge for the period. And then we have the accumulated depreciation charge carried forward. And then our brought forward for July is our cost brought forward minus our depreciation brought forward. Obviously, as I mentioned earlier, I'm going to be doing a video on depreciation separately, so just know that that's the cost incurred each year to bring the asset to a realistic value within the books. Because obviously if you buy a car for 20 grand, 3 years down the line it's not going to be 20 grand, so you depreciate it. And then our carried forward is going to be for August, so that is our costs carried forward including the additions. It will be our accumulated depreciation carried forward, which includes our depreciation charge for the year, and then that is the brought forward versus the carry forward, and our current period is obviously August. If we go to the next tab, fixtures and fittings, you can see we've got our description of what our asset is. It's this one. We are missing dates here because we weren't given them when we got the client from the last accountants, but you can see the costs. You can see there are no additions. We've got accumulated depreciation brought forward of £3,000 here. What we've done here is we've just applied 1 month of depreciation, and then if you add these two together you get our carried forward, and then it's the exact same on our IT equipment. And that is pretty much how you would maintain your fixed asset register. So it sounds a lot, but it's actually super simple if you understand the premise of having your costs in there, and then you minus depreciation, and that's how much should be in your accounts. So if you enjoyed this video, please drop a like and subscribe. If you have any questions, comment it in the comments below, and I will see you on the next one.